tonight's session is not to turn all of us into accountants. It's really to try to help entrepreneurs like yourselves know enough about budgeting and financial planning to kind of be dangerous.
Good evening, everyone. My name is Carrie Damon. I am the Director of Entrepreneurship Programs here at Mars, and I just want to welcome you to our financial planning and budgeting session. I also want to welcome those that are watching via webcast, and to our webcast satellite centers, say a shout out to NORCAT in Sudbury, Innovation Factory in Hamilton, and Hull Tech. We have a number of really great announcements today. We're nearing the end of the year. We're in our last module, the money module, which is the most important module because almost every entrepreneur that comes into Mars, their first question is, where do I get money, or how can you help me get money? So the Upstart competition is happening May 15th, and we have the final 12 companies. Originally, we were going to go for 10, but we couldn't get our advisors to make the hard decisions. So there they are. Are any of the Upstart competitors in the room? Stand up and shout out your name. Oh, receiver. Adobe, and that's it? Okay, so we'll go through them. I'm just going to do a quick description of what they are. T-Bot is an automated kiosk that provides customized products. Set Scouter is an online marketplace for filmmakers to access production space. Receiver, which is right here, is an online platform that curates a library of streaming content, which is a very cool idea. Nano Supply, a platform that connects researchers with global nanomaterial suppliers. Kidobi, here, software application that curates children's video content. Formarum is an all-in-one sanitation device for recreational water features. Barungo is an online training tool that aims to improve workplace and email communications. Biome Energy is wind turbine modification to improve safety and efficiency while reducing noise. Reditech is an automated desktop recycler of plastic filaments used in 3D printing. InTouch, tablet application that allows seniors to communicate with family, caregivers, and healthcare professionals. Linxio is an orthopedic knee brace that monitors and visualizes the progress of physiotherapy. And lastly, Vessel Innovations is a system that allows business owners to evaluate inventories of bottles via several methods. So we've got a wide range of technologies, clean tech, life sciences, ICT, all kinds of software, all kinds of online platforms and marketplaces. The Upstart competition is a pitch competition. There are judges that will be evaluating these companies to award our KPMG sponsorship of a $15,000 prize. But we also do a People's Choice Award. We really want to reward companies that are the audience favorite. So we encourage you to come and to contribute to or support the winner of that prize. And we also have an announcement that the applications for our summer 2014 cohort for Jolt are open. If you haven't heard of Jolt before, it's our incubator program on the second floor in the Mars Commons building. It's a 6-month program, $50,000 investment, over 100 mentors. They get workspace at Mars, so you're working with the other companies in the accelerator, and there's about $600,000 worth of partner perks. So it's a pretty exciting program. It's a very intense program. So if you're interested in that, the website is jolt.marsdd.com, or email info@joltco.ca. And with that, I'm going to introduce our speaker tonight, Andrew Graham. Andrew is formerly from the corporate world and has been sort of dipping his toes into the entrepreneurial space for a number of years and finally made the leap, I learned just last year. He's also a new father of a 7-week-old. So he is a financial services entrepreneur currently pursuing opportunities in alternative lending. Previously, he led President's Choice Insurance, PC Insurance, part of the Loblaw Weston Group and one of Canada's largest insurance brokers. He's experienced in corporate development and corporate strategy, having worked in mergers and acquisitions with George Weston Limited and Nortel. He's an MBA from Harvard Business School and an MA in economics from the University of Edinburgh. He is a co-founder of Toronto Homecoming, which is a profitable social enterprise that helps talented Canadians living abroad connect with job opportunities in Toronto. I actually could have used that when I was living abroad, when I'm trying to come home. So he's a social entrepreneur on the side as well. So we welcome Andrew to talk to us today about financial planning and budgeting.
Hi, everybody, and welcome to tonight's discussion. What could be a more fun way to spend an evening than talking about financial planning and budgeting? I'm impressed you're all here for that reason, particularly given the ugly weather. The goal of tonight's session is not to turn all of us into accountants. It's really to try to help entrepreneurs like yourselves know enough about budgeting and financial planning to kind of be dangerous. So that's our goal tonight. And maybe before I start, let me just do a quick survey in the room. So who's in the process of starting their own venture right now? Okay, that's great. And who's sort of thinking about it more, long term? Some people. That's great. And who is doing this because you're really passionate about a product or a service? And who is doing this because they want to create some sort of change in the world or in a market? And who's doing it because they're really into financial planning and budgeting? One person, a couple people. We should talk after. I don't know if this is if that's the right way to approach things, but we can discuss. So listen, we all know that financial planning and budgeting isn't the reason that most people, except for these two gentlemen, go into entrepreneurship. But it's an important activity that you have to do to sustain your venture. Okay, so that's why we're all here, I think, this evening. And we know that financial planning can be complicated. And like in all things to do with business, I think Dilbert has a great perspective on things. So I think all these there's all these acronyms that we see with that Dilbert is that's being talked about here. And again, there's a lot of complexity. Our goal is not to sort of have you come out of here as experts. It's to have everyone come out of here with knowing what the right questions to ask as entrepreneurial CEOs. So it can be complicated, but financial planning is important. So I want to just ask, what are some reasons why financial planning matters to a startup? Who wants to sort of shout one out? And we'll see how well they sort of map onto what I put up here. Go ahead, yeah. Great, okay, so there's sort of a sustainability aspect that if you've got a business, you're not bringing in enough money, you're going to go out of business. That's great. Anyone else? Yeah, go ahead. Sorry. So as a way to sort of know what to do with limited resources. Yeah, that's great. Anything else? Yeah. To encourage investment, and both sort of to reward your investors and ultimately to reward yourself. So I think that those all map really well to what I have here. So first of all, money matters because you have to pay the bills. And if you don't pay the bills, as this gentleman mentioned, you're going to quickly go to business. Another reason that money matters in a startup and financial planning matters is that it's a good indicator that you're on to something. So if you launch a business and nobody buys your product and there's no money coming in the door, that's probably a good indicator that your product isn't one that the market wants, or the market doesn't want it at the price you're offering it. And then the final thing is, for many people, earning money, having your startup be profitable is a great outcome that you want. You want to, if you're interested in earning money. So tonight we're going to talk about 3 different tools for financial planning. These are really like the 3 key tools that I think most businesses use, and certainly for an early stage business you want to use. The first is an income statement, and we'll talk about that in a minute. Then there's a cash flow forecast, and then finally a balance sheet. So if many of you may know what those things are, some of you may not, we're going to go through each of them using sort of case studies to look at how these statements are used by real businesses. So first of all, the income statement. Now the income statement, the first thing to know about an income statement is that it covers a period of time. So an income statement is for typically a year or a quarter or a month or some period of time. And what it's trying to tell you, what an income statement can tell you or investors, is how a business is performing over that period of time. So we're going to talk about the balance statement later on. The balance statement is for a set moment in time. So a balance statement will say on December 31st, here's what your assets were. An income statement says for the year 2013, here's what the inflows and outflows were to the business. Now the business I thought we'd talk about tonight is one we all know, and it's Amazon.com. So who's never used Amazon.ca or .com? Okay, so it's one almost all of us have used. And these numbers that I've pulled here on the slide are the actual numbers from Amazon's latest financial reporting, which was for the year ended December 31st, so they're annual financial statements. And these are pulled from the internet. Anyone can go download these from Amazon. And I thought it'd be useful to look at a sort of a real-life example to understand a business. So how does Amazon earn its revenues? And we'll talk in a minute about what revenues are, but how does Amazon earn money? Yeah, go ahead. So it sells products. That's definitely the biggest way it earns money. What kind of products? Books, clothes. Anyone bought something really exciting from Amazon before? What's that? A white noise machine. There's something exotic. I have a 7-week-old, so I'm very familiar with white noise machines. I wish white noise machines worked better for my 7-year-old than they seem to, a 7-week-old. So the bulk of Amazon's revenue comes from selling stuff. Amazon also makes money from services. So they also host web services. So if some of you have startups, maybe you're using Amazon's cloud platform as well. So we're going to go through the income statement line by line, and we've just talked about revenue. Revenue is a fancy way of saying the money brought into a company by its business activities. So this is kind of what a business does to earn money. If you're selling hot dogs, your revenue comes from the money you get from the sale of hot dogs. Now, there's 2 different ways of forecasting revenue, and forecasting revenue is really important. We heard a bit about it in the video earlier. When you're putting together a business plan, you want to try to create an estimate or a forecast of how much money is going to be brought into the business over a period of time. And there's 2 key ways to do revenue forecasting. The first is top-down. And we heard in the video, when you're doing top-down revenue forecasting, that's when you say, listen, the market for widgets, the market for hot dogs in Toronto is $10 million a year. And I think I can capture 1% of that market. So that's a kind of a classic top-down forecast. The other way to do forecasting is bottom-up. Does anyone know what bottom-up forecasting looks like, why it's different? Yeah? It's you mentioned from the customer's perspective. Yeah, so you're really looking at a much more granular level, saying, I think this customer is going to buy 50 of my products, and this customer is going to buy 100, and I believe that because I've talked to them and they've indicated that. I guess in our hot dog example, you sort of say, I think that by setting up my stand at Yonge and Dundas for these dates, specifically I know what the sales volume is, and that's what I can do. So it's a much more granular way of going about things. So what's an advantage of bottom-up? Anyone? Yeah, go ahead. So more accurate and more realistic. Yeah, I think that's absolutely right. So why wouldn't everyone always do bottom-up? It looks better when you do top-down. OK, that's one way, yeah. That's one reason. Sometimes you lack the information or the methods to build the model from the bottom. Yeah, you're absolutely right. It can take a lot of time and effort to go out there and interview all your potential customers or do a big market survey. So often businesses will start with top-down, yes, that's right, start with top-down, and then use that as they develop their business plan. And then as things get more advanced and more complicated, they'll move to bottom-up. Because ultimately, that's going to give you hope, a more accurate view. So let's keep going down the income statement. The next line we're going to look at is cost of sales. And these are costs that go into creating the products and services that a company sells. So let's take Amazon's business of selling stuff. What are some cost of sales? So in the example that we heard earlier of a white noise machine, what are the cost of sales for Amazon in that example of selling a white noise machine? Yeah. So the products themselves cost money, so they have to buy the white noise machine from the manufacturer. Amazon doesn't make it itself. Or they have to buy the books from the publishers, because again, Amazon isn't publishing or they're not printing the books themselves. That's great. What else is a cost associated with this? Yeah. So storage and inventory. Yeah, we can. Let's come back to that in a minute. I heard someone else say shipping. So shipping, I think you're right, is another sort of direct cost to do with sort of selling stuff. We get into more complicated territory with some other kinds of costs, and we're going to look at this later in the balance sheet, because businesses have some costs that are directly related to the product, like buying the white noise machine. But what are some costs that Amazon would have that are not at all related to the sale of the white noise machine? Maybe some we haven't heard. Or, yeah, go ahead.
The cost of servers.
So the cost of servers. OK, so they've got a big IT platform that you can't really say this server was to support this sale. What else is, yeah, go ahead.
Development, marketing.
Development and marketing, that's great. So again, Amazon has ads, they're advertising in various places. That's not associated with any one sale, so that wouldn't go into the cost of sale line. And different companies will treat costs like warehousing and inventory in different ways. I think if it's related to the actual selling of an item and you can trace it, then it would be in cost of sales. But certainly this is where, as we get into the sort of this more complicated accounting territory, this is where sort of specialists would come in and say, yeah, this is actually cost of sales. This, this is more of a general cost. And if you're a big company, that matters a lot. For our purposes as early stage ventures, what's most important is just understanding the big buckets. Okay, so Amazon sells stuff, but they have to pay for stuff and pay for shipping. And the difference between those two things is their gross margin. So gross margin really is very simply revenue minus the cost of sales. Let's talk about gross margin for a minute, because it tells you a lot about what a business does. Okay, so Amazon, you can see here the calculation is just the 20271 over 74,452, and that gives you 27%. Okay, so they have a 27% gross margin. Now think about LinkedIn. So everyone knows LinkedIn. You are all on LinkedIn, I assume. How does LinkedIn make money? Okay, so ads and services. I mean, they're selling their platform. No physical products. They're selling their platform online in a way. So do we think Amazon is going to, LinkedIn is going to have high cost of sales or low cost of sales if they're selling virtual stuff? They call it, links and premium services. Comparatively lower. So we think their cost of sales is going to be lower. So what does that mean then for their gross margin? Should you think it's going to be higher or lower? So you think it's going to be higher? Well, I think you're absolutely right. So LinkedIn's gross margin is 81%. So a very high gross margin business. Now, I think on the flip side, LinkedIn is going to have a lot more costs, or may have a lot more costs than other kind of businesses do when it comes to other kinds of costs. But I agree with you that on a gross margin basis, they have a very high number. Now let's look at Toyota. So we all know what Toyota sells. They sell cars and other kind of vehicles. So do we think they're going to have a high gross margin or a low gross margin? So a low gross margin. So who wants to talk about that for a minute? Who said low? Yeah, go ahead. Yeah? So what this gentleman said is that there's lots of cost to build a car and the infrastructure around it as well, and all the people as well, right? I mean, there's a lot of labor that goes into building a car. So they're selling high-value items that take a lot of cost. So Toyota, in fact, is a 13% gross margin. So whether your gross margin is high or low isn't necessarily a good or bad thing. It's more sort of telling you something about the business. So different kinds of businesses have different kinds of gross margins. There's a lot of bad businesses that have very high gross margins, and there's good businesses with low gross margins. I mean, Toyota and other manufacturing businesses are going to have much lower gross margins. That doesn't mean they're bad. I think one thing to do is look at how a gross margin changes over time. If you're in the same business and your gross margin is falling, boy, that would make me worried if it were my business. Sort of say, what's happening? Am I not able to get as much price from my customers, or are my costs increasing and I can't pass those on to my customers? So looking at gross margin over time can be very instructive. And it can also tell you a lot about, again, what kind of business the company is in. So now we'll keep going down. So now we'll look at operating expenses. And these are business costs not related to producing goods and services for sale. So in Amazon's case, we talked about some of the servers. We talked about some of the advertising. We talked about marketing. It's all those sort of costs that you can't tie to the sale of products, but that a business has to do. So salaries can fall into both buckets. So let's think of Toyota. What are some salaries that would go into the cost of sales line? Anyone want to comment on that? Yes, sir? Production line people. So people actually building the cars. That's great. And what's the salary that wouldn't go into the cost of sales line? CEO. The CEO, right. So there's someone at the top. There's many people at the top of Toyota who are doing marketing and running the company. But because they're not actually building cars, a specific car, their salaries and so forth go into operating expenses. And we have a number of different buckets under operating expenses. The first is selling, general, and administrative expenses. And this is sort of a big catch-all that you'll see very often on income statements. And it's exactly the kinds of things we've talked about. So selling, like advertising, general expenses, and administrative expenses like your CEO's salary, like the paper that the CEO uses to print off a document. All that kind of stuff would come into the selling, general, and administrative expenses. So going further down the income statement, a line you'll often see is research and development. Here it's technology and content. This is what Amazon decides to call it on their income statement. And I left it as it was, I think, to illustrate the point that while there are a lot of standards when it comes to accounting and to presenting documents, companies do sort of take liberties and do sort of change things around. So if you're looking at Amazon's income statement, you're not going to see a line for research and development. You are going to see a line for technology and content. So in Amazon's case, what do we think falls into here? Did anyone see the video that Amazon released of their little helicopter? So Amazon released a video, I don't know if all of you saw this. They are developing a helicopter that can pick up packages at the Amazon depot and fly it to your home. So you can have a package delivered in an hour. So these aren't in general production. Amazon isn't delivering packages with these. But somebody spent a lot of money trying to produce this helicopter. And that would have come out of their technology and content budget. Now, the word content makes you think that Amazon is doing some other things here. Maybe they're producing their own content, their own books perhaps. But when you think of research and development, it's more classically coming up with new ideas, coming up with new products, et cetera. And some businesses are going to have a lot of R&D costs, and some businesses are going to have almost none. So what's a business that's going to have, you think, almost no R&D spending? A hot dog stand. That's a great idea. Unless you're coming up with your own hot dog recipes, you're probably not going to have a lot of money spent on R&D. I used to work for Loblaws, big retailer. As a percentage of the overall income statement, there's not a lot of R&D happening. I mean, it's a retailer. They're selling stuff. And similarly with other kinds of companies like that. On the other hand, you can have very small businesses that have a lot of money invested in R&D because that's key for their product development. So then continuing down the income statement, we have depreciation and amortization. And this, I think, sounds a bit daunting as the definition, but we'll go through it. It's the reduction in the capital value of an asset over time. So let's think of an Amazon warehouse. So you've got an Amazon warehouse filled with books and stuff, and you've got a whole bunch of shelves, and you've got little forklifts driving around getting stuff. So when Amazon buys a forklift, for example, the way it's treated from an accounting perspective is you don't expense the full cost of the forklift in 1 year. You would amortize it over a period of time. So when you buy capital goods, you're allowed to expense it over a number of years to sort of recognize that this item isn't for a one-shot use. So what this line is telling us is that there's capital items that Amazon's bought this year or in the past that it's taking costs for over a number of years. Any questions about that? I know that can be certainly one of the concepts I find trickier. Or any comment? Yeah, go ahead. So would computers and tablets fall into the category? So that's a great question. It really depends on the useful life of a thing, and there'll be accountants in a big business sort of paid to know the accounting rules and come up with an answer to that kind of question. My understanding is generally yes. A computer is longer lived than a year or what have you. So it normally would be it would come into that. Now, not all items are depreciated at the same rate. So a computer, a laptop, is depreciated much more quickly than a building. Okay, a building can have a 30-year life for depreciation. Yeah?
Is there standardized accounting, laid out to be like, a computer is 4 years, or is it subjective based off the case?
So the question was, are there standardized rules around, around what the item, around for a specific item, how long it's depreciated? That's a great question. I mean, I know, do we have any sort of CPAs in the room that have an answer to that? Yeah? So just the answer. So the answer, just for the benefit of everyone who didn't hear that is, and thank you, is that there are sort of specific classes for different items, and that was certainly my understanding as well. But again, this is where we're sort of, you eventually want to get an expert to help you with this kind of thing. Well, one last question, then we'll move on.
What if you get the asset for free?
What if you get an asset for free? Oh, that's an interesting question. So what do we think happens if someone gives you an asset? Yeah, you'd have to come up with a market value. I mean, if it's now an asset that you own, and if you'd need to sort of show that this asset has some objective value, and then you'd typically put it on your balance sheet, which we'll get to later on, at that value, and there could be depreciation. I'm going to keep going, if that's okay, unless it's a burning issue.
I was just going to say, just to be clear, it doesn't count as an operating expense if you never paid for it, but it would go into your assets at whatever amount you want. I just wanted to clarify that.
So it would, in this case,
We're talking about operating expenses. So
right.
the gift wouldn't go into the expenses, it would just go into...
So on an income statement, if you get a bunch of gifts, I mean, this is, now we're getting into a situation that doesn't happen a ton in business, but if you did get a bunch of gifts, you'd find different ways to recognize those gifts. You may even recognize them on the income statement as sort of a form of revenue, if you will, or a form of an increase in asset value. Okay, so going further down the income statement, we have interest and other income and expenses. So why would Amazon be earning money from interest? It's not a bank, at least not yet. So there might be a lag. They might have some cash on the balance sheet. Yeah. Right. So there's a positive cash flow. The company is accumulating cash. They may be earning interest on that. So that's great. It's a great point. And similarly, if the business is borrowing money, they may have expenses related to borrowing. And the reason we show it in a different part of the income statement is to say this isn't really related to their operations. So Amazon isn't in the business of taking cash and earning interest on it. It just happens to be something they do. So we split it out from the operating section up top with the revenue and the cost of goods and put it lower down to say, listen, this isn't what they do day to day, but we do have to show that it's an income and expense and indeed sort of show it on the income statement. Yeah?
The line above that, income from operations, why is it not equal to gross margin minus total operating expense?
Well, if it isn't, then there's been some sort of mathematical error on my part or Amazon's part, so it should be. Okay, let's keep going. So below income from operations, we have taxes. So of course, we all know what taxes are. Businesses, like individuals, have to pay taxes. And then that gives you a net income line. And the net income line is your profit. Okay? Any last burning questions or thoughts on the income statement? Okay, so we're going to switch from the income statement now to talk about cash. And when we were in our discussion about the income statement, we were thinking about what's called accrual accounting. Okay? And a very simple way to think about that is, let's say you're a business and you sell your Amazon, you sell a book today, but you're not going to collect on it till next year. On your income statement, do you show that as revenue or do you not? I mean, on the one hand, you sold the book, a customer's taken it and said, I'm going to pay you, but you're not getting the cash till next year. And that's one of the big distinctions in accounting between what's called accrual accounting, and that's sort of saying we'll account for things as the activity happens rather than when the cash happens, and then cash accounting, which says let's just follow the cash. And I think one of my main messages tonight is it's not that one is better than the other. They're giving you different views about the business. And we're going to spend some time tonight looking at when one is good and when one is not good, and some of the sort of the strengths and weaknesses. So we've got a fictitious company here called Tom's Solar Power Company. And it's a very simple business. They buy solar panel, they create solar panels from these little cells. And it's a very simple business model. Tom buys them for $50 and let's say assembles them somehow without cost, just to keep it simple, and he sells them for $100. So the total cost of the items, the total cost of goods is $50, and the revenue from a panel is $100. And Tom's put together this business plan, and who's ever put together a business plan that looks like this? This is how all business plans look. So Tom's done he's done a great job with his bottom-up forecasting, and he's forecasted out for the whole year, and he's got a very good idea of what customers are going to want. And you can see that he's planning on selling a certain number of units every month, and there's a revenue associated with each of those every month. But there's a wrinkle here. So let's say you're a new startup business, and you go to your big supplier of these solar cells, and you say, hi, I'm Tom, and this is my new business. I'd like you to give me the solar cells, and I'm going to put an order in, you're going to give them to me. What do you think they're going to say about when you have to pay them? Now, I think that's exactly right. They're going to say, I have no idea who you are, you have no history, you have no money in your bank account or very little, so you've got to pay us now. And by the way, if you put an order in today, I want the money now, but I can't, it's going to take me 30 days to actually get you the stuff you order. Okay, so this is a very normal scenario, and in fact, often it can be even longer than that. And then on the flip side, if you are installing solar panels on call it the roofs of big companies or big clients, do you think they're going to pay you the same day that you finish the job? No, often it can take 30 days, 60 days, even 90 days to get paid. So as a business, you've now got sort of gaps between when an activity happens and when the cash comes in the door. So when we were looking at the income statement, we said that's with accrual accounting. So that's all about when the activity happens. So if you sell a solar panel and you install it, I'll just, rather than ask you the question, I'll just answer it. You'd recognize the revenue from that on the day, on the minute, in the second when you installed it. Okay? Even though the cash to buy the panel went out the door a month ago, and the cash that you get for selling the panel isn't going to come in the door for a month. So let's look at the effect of this when you look at a cash flow statement. So this is the income statement. So we had the forecast earlier of sales, and so this income statement, boy, it looks pretty good. Tom's got $1,000 every month of costs. And as you can see, sales start in February, and he's selling stuff for double the price that it costs him. So he's got a great 50% gross margin. And boy, it looks like a great story. So let's look at let's take this income statement and turn it into a cash projection. So let's say Tom starts off with $25,000. He says, I know I'm a startup, I need to get money. He goes to his friends and family, he raises $25,000. Now in the first month, he's got no sales. But he knows that the next month, he has sales, right? He had 50 sales in February. So he knows that he's got to order the equipment, he's got to order these cells now to be able to fulfill those orders. And then in February, it's a similar story. So now he's got to order his cells for the next month. And at the same time, he didn't have sales in January, so he's got no revenue coming in the door in February. So he lost from a cash perspective, he lost $3,500 in January. But let's look at February. It's really interesting. His net income was $1,500 in February, yet $8,500 of cash went out the door. So this is the big difference between accrual accounting and cash accounting. So let's keep playing the movie here. The next month again, Tom's losing $8,500, even though he got $5,000 in revenue finally from what he sold in February. One more month ahead, Tom is now bankrupt. So even though he's got a great business, he's got a great gross margin, he's got lots of customers, his forecasts were bang on, because Tom didn't spend enough time looking at his cash needs, he's actually run out of cash. So it's one of those strange things in entrepreneurship. A business can actually grow so quickly that it goes bankrupt. It's kind of a strange concept. Because his costs were a month ahead and his revenue his cash comes in the door a month later, he's got to fund what accountants call working capital. And if he didn't plan it, in this case he didn't plan it, that leaves him with a big gap. And you can see that in May it gets even worse, and then by June things are starting to turn around as the revenue from the previous few months starts to catch up. Any questions or thoughts about this cash view of a business? Yeah? So you're saying the conclusion is you need working capital. Absolutely right. I think the way I read the conclusion is you've got to have a good sense of how much you need to raise. because you don't want to be in the situation where you're having to, so to just rewind it for a second, so let's say Tom, so what are some things Tom could have done to avoid this problem? Yeah, go ahead.
Looked at his projections and figured out what working capital he needed for a particular period.
That's great. So he could have looked at his projections and said, boy, I'm going to need more than $25,000 to start. What else could he have done? Yeah? He could have sold less. That's right. So it's kind of a weird situation to be in. A customer's knocking on your door saying, listen, Tom, I'd like to place an order for 100. And Tom says, sorry, I can't. I mean, let's talk in a few months. I just don't have the cash to be able to fund, your purchase. So very strange as an entrepreneur to have to do that. But in Tom's case, it probably would have been a better decision than going bankrupt. Yeah?
I was told somewhere, I'm not sure this is true, can you borrow against accounts receivable?
So can you borrow against accounts receivable? So that's called, some people call that factoring. So in some cases you can. It really depends on the quality of your accounts receivable. So if you're selling to a hot dog stand, no one's going to give you money probably to collect against a hot dog stand. If you're selling to Loblaws or Royal Bank, and they believe that they study the quality of your accounts receivable and they believe that it's good, then maybe someone will give you money against it. Yeah? So don't pay the suppliers until they really ask for it. Yeah, that makes a lot of sense. You want to collect as early as you can and pay as late as you can. And if you think about it, there are businesses out there that actually have the reverse situation. So who's ever ordered a computer from Dell? Okay, so Dell's got a great business model because with Dell, when do you pay for the computer? You pay for it up front, and when do you get the computer? You know, days or weeks later. So Dell takes your money, and then they say to their suppliers, you know what? And their suppliers are all based very close to them and say, you know what? We're going to need a couple of microchips from you to build this computer. So Dell actually collects cash and keeps the cash before they have to put it out the door. I worked for Loblaws, a big retailer. Retailers often do this. Retailers are notoriously tough with their suppliers. And they'll say, you know, listen, Kraft, I know you're giving me this food. I'm not actually going to pay you for 60 days. And when you go in to Loblaws or any grocery store and buy food, who's ever said, listen, I'm going to pay you in 60 days for this food? Right? You have to pay for it there. So again, these are businesses that are able to have positive working capital, as it's called. Okay, let's keep going. So the lesson here is you need to forecast cash flows. So this is a plane at an air show. Things look like, okay, it doesn't look great. It's going downwards, but I don't know, how bad is the situation? Okay, it's pretty bad. So there's the pilot out, who's just ejected. So if you don't forecast cash flows, you really are flying blind. So in this case, Tom made a big mistake by not forecasting things out and seeing what the situation was. Now, another concept we'll talk about in this section is EBITDA or EBITDA. Everyone calls it EBITDA. I don't know, who's heard that term before? So EBITDA is used a lot in investing circles. Investors often look at EBITDA. And EBITDA is a fancy way of saying earnings before interest, taxes, depreciation, and amortization. And why it's a useful measure is you're trying to strip out the costs that are kind of non-core. You're trying to strip out the costs that the business would be able to generate regardless of its tax and regardless of its financing situation. So you could have a business that's making a lot of money. If it's got a lot of debt, it could have very low net income because it's had to pay all this money at the door for debt. And if all you're interested in is the quality of the underlying business, you want to be able to strip that out. Similarly, if you're a private equity fund, you may not be interested in the taxes a business has to pay if you think you can move it offshore or move it somewhere else. Or if you think there are sort of, if you're going to take other kinds of losses in the future, you may not care about tax. So EBITDA is basically, it's a concept that investors look at, and I think it's just sort of just knowing, it's worth knowing the acronym. And if next time someone says EBITDA, you can say, oh yeah, I know what that is. So the next, and I guess the final of the different documents we're going to talk about tonight is the balance sheet. And as I mentioned at the start, a balance sheet is a snapshot at a point of time in a business. So income statement, statement of cash flows is over a month, a quarter, a year. Balance sheet is a point in time. So it's sort of like saying, okay, everybody freeze. How much stuff do we have? So here's a balance sheet for Tom's Solar Power Company. This is at the end of February. And we see on the balance sheet there's a lot of items that we recognize, like cash, accounts receivable, which is what our customers owe us. And that was Tom's problem. He always had a lot of accounts receivable. inventory, which he's already paid for, building and equipment and land. And a good trick that I learned that someone taught me about a balance sheet is typically, as a rule of thumb, the lower down you get in the assets, the less liquid an asset is. So typically, when you look at a balance sheet, and if you're, the higher up you go in the asset section, the more like cash it is. So cash is obviously a lot like cash. It is cash. Accounts receivable is going to likely turn into cash soon, or maybe you can sell it. And as you start getting lower, inventory, building and equipment, land, that typically goes on the balance sheet at the value you paid for it. That may have been 10 or 20 years ago. So who knows if it's still worth that. So the higher up you look in the asset section, the more sort of confident you should feel about the quality of the number. Yeah?
Inventory or land, like you say, that might have been there for 20 years. Is it appreciated, or do they appreciate each year or depreciate each year?
So the question was around, for building and equipment and land, do you change the value of that over time as the values of those things change? So the example I was giving of something that's very hard to change the value of is, let's say you go out and buy another company. And when you buy another company, it's very hard to sort of objectively know how the value of that's changing year to year. Though companies do occasionally take write-downs. You'll hear in the news, oh, a company took a big write-down on their purchase of X or Y. Now, the different statements tie together. So you have, on the left, you have the income statement, and on the right, you have the balance sheet. And you can see that certain things are going to tie. So the first thing that ties is ending cash. So in February, we say we ended the month with $13,000. Well, that should tie to what's on the balance sheet for for the end of that period. Another thing that ties is going to be, in this case, revenue. So because all of your revenue gets paid the next month, for this business, all of the revenue essentially turns into accounts receivable. So some final thoughts, and then we'll pause for questions. First of all, it really is all about the cash. Accrual accounting is really good so that you have a sense of how a business is performing, and it tells you things like the gross margin. But ultimately, you need to understand your cash position so you don't sort of go bankrupt. Next thought is we talked about the advantages of forecasting bottom up versus top down. To the extent you can, really try to get bottom up. It's, there's been so many business models in the history of the world where someone said, I can take 1% of some massive market. And even though that sounds good, it actually never is as easy as it sounds, and the business hasn't been successful. Next, it's great to create multiple scenarios. So for those of you that like Excel, Excel is great about this. So if you went into Excel and you said, what if our cost of sales goes up by 5%? What does that do to my bottom line? Or what happens if the price that I can get in the marketplace goes down by 2%? How sensitive is my bottom line to that? Getting into that kind of level of understanding of your financials will really help deepen your understanding of the business. And it probably means there's 5 or 10, maybe fewer drivers, key things that are driving your business. And you say, boy, if my SG&A line goes up a little bit, that's not a big deal. But boy, if my cost of sales, if my supplier tries to raise my prices by even 2%, that's going to have a massive effect on my business. So if you think about Toyota, imagine Toyota's supplier said, we're going to charge you 10% more, Toyota, for all the metal you need for your cars. I mean, that's a big deal for Toyota. And the last thing is get expert advice when you need it. So I think one of the things I've taken away from what I've studied in accounting as a non-accountant is that there's a lot of depth here, and even tonight we've had some questions that are sort of verging on the technical. And just like in law, or just like in many other things, there are people that do this for a living, and knowing when to go to those people and get help is, I think, a key lesson. So with that, I will pause and we'll go to questions.
So if we go back a slide to the balance sheet that you had up there under owner's equity, if I'm funding my own business, like I'm paying the bills every month personally, is it safe to say that value is going to be increasing every month, or how would that work?
So that's a great question, and we can touch on owner's equity right now. So the simple way of thinking about owner's equity is that it's the difference between your assets and your liabilities. So if your business is generating value every month, and you're taking in more assets than you are paying out in liabilities, then your owner's equity is going to increase. So that's kind of a notional amount. That doesn't mean if you went and tried to sell your business tomorrow, someone would pay you exactly what's there. It really is a mathematical relationship. It's just the difference between assets and liabilities.
Okay, so at some point you could pull out that equity. for that amount if you had the money for it, for example?
Well, so it's a good question. I think, it's like one of those things, like in theory you could. So so let's say you have, let's say you own, in a very simple example, let's say you own an asset which is a house, and it's worth $100,000. And the other side you have a liability of a mortgage which is $50,000. So could you pull out the $50,000 difference? That's your owner's equity. Well, maybe if someone's going to lend you that money against it, but they would have to believe that the asset is still worth what you say it is. So it's never quite as easy as it sounds, or rarely is it as easy as it sounds. You'd have to get someone to believe that your assets are worth what they're actually worth, what your balance sheet says they're worth.
Okay.
Hi. I was wondering how to operationalize this. So for example, I run classes, we buy supplies for it. One day I make this amount of revenue and I buy supplies that stretch over multiple classes. What do I then do with those revenues and expenses?
So you're buying supplies and then you're selling the supplies?
No, we do classes. So
Okay.
we use the supplies within those classes.
Okay, and then you get paid for running the classes?
Yeah.
So so your revenue would be the money you get for running the classes?
Yeah.
And the cost of sales would be everything to do with what it costs to put on the class? So the supplies, and I don't know if you pay anyone? Yeah,
Definitely. I'm just wondering, like, day to day, how to implement all of this. Like, from one day to the next, make sure we have enough cash, for example.
So great question. So I think what you really want to do is you want to have someone who's sort of responsible in your team to look at this, and then they're going to use some sort of software to plug in and make a forecast for your business. It could be Excel, it could be some other accounting software, and really understand what the next few days, weeks, months is going to look like. And it could be a really simple model in Excel. I don't know if you use Excel much.
Mm-hmm. Okay.
Does that make sense?
Sort of. And then when we get the actuals, compare them back.
That's good to compare and say, what did we do right with our forecasting? What did we do wrong?
Okay, thanks.
There are a couple questions coming from the webcast. One is coming from Peter. He asks, how do you factor in the fluctuation of the Canadian dollar if a lot of your sales are outside Canada?
Okay.
Do different scenarios?
That's a great question. I think you're right. When you're doing your forecasting, if you know a lot of your sales are going to come out from outside Canada, you want to make sure you understand what the impact of those changes or possible changes in currency are. So there's always risk in a business if you have a lot of revenue in one currency and a lot of expenses in another. So I was looking at a business the other day that sells stuff throughout North America, but all of their expenses are in Canada. They are headquartered in Canada, or a lot of their expenses are in Canada. And when the Canadian dollar goes up and down, that affects their bottom line. So that would, you certainly want to model that out, and you'd have to take that into account in your financial statements.
And linked to financial topics, we actually have a Mars Best Practices tomorrow at lunch on shred and tax planning, because I'm sure it's that time of year for some entrepreneurs. There are two other questions. One is, what is income from operations? What does that consist of? Could you give an example?
Income from operations. So should we go back to the Amazon example? Let's go back to, we'll get there real quick. We'll get back to the Amazon. So income from operations is, from an accounting perspective, is you're taking your gross margin and you're subtracting your operating expenses. And that gives you your income from operations. So if you think of gross margin as what you get in minus the cost of what it takes to produce that stuff, and then operating expenses is everything else to do with running the business, what's left is income from operations. So it's kind of like your profit before all the kind of non-business stuff like interest and taxes.
And just a note on the strategy for getting somebody to help you. I know a lot of people go and they get an accountant, and the accountant really just does tax planning or their taxes and doesn't really offer a lot of advice. So they think the advice would come from getting a CFO, but not all companies need a CFO. Can you talk about the transition from having somebody help you with some of the things that they are experts like taxes and bookkeeping, to where a company would actually need a CFO, somebody that could strategically manage the financial assets in the company? Because some people get it too early, I think. They get a CFO, and they're too expensive for what you require them to do.
So I think any business from day one, if you're in business, there's some skills you have to have. So you have to have someone who can file your taxes. That's not something that, as a non-expert, you're going to be able to do. and you want to make sure you get that right. There's obviously big downsides to getting that wrong. And I think you also need a fairly robust forecasting function. So you need to be able to understand what's going to happen in the future with your cash, to exactly the point we made. Now, hopefully you have someone on your team, maybe it's you or maybe it's someone else, who can do that, so you don't have to sort of pay an external person like a CFO for that. I mean, there's, CFOs encompass a very wide range of skills, and there are, some CFOs that do very little and some that do a lot. And I think it's a question of ensuring that as your business grows, you have the essential skills at all times. So you always need some planning. You always need some amount of sort of day-to-day accounting, so you can be honest with your investors and authorities. And then beyond that, as things get more complex, you may want to start about bringing in specialized help, and that may be someone with a CFO title. It may be something else. And I think there's even, I think there may be even some at Mars, folks who are happy to be like 1 day a week CFOs. So you doesn't mean you have to bring someone on full time. You could bring someone who would come in 1 day a week or 2 days a week, for example. I don't, if that answers the question.
And we're actually starting to build a series of financial workshops. So if this is a complicated area, and if you have any ideas for what we should include in those, definitely shoot us an email. We're starting with some of the same topic, so getting people to more understand financial statements, but also getting into more complicated topics like valuation. I think that's all the questions for tonight. So, we got one more.
If you want, I think there's a microphone there for questions, sure.
You briefly touched on some of the ratios that the different businesses had. In fact, although the absolute values will matter for things like discussions with your bankers, that the ratios are important, and the changes in those ratios over time. There's also other things which are not formal appearance on the balance sheet. Things like how many days outstanding your days sales are outstanding. If that starts to go up, then you need to look at your bill paying process or your bill collecting processes. Would you say a bit about some of the other ratios that might be significant?
So I think you're absolutely right. I think there are a number of different, the challenge is there's a lot of different ratios out there, and it can really depend on the kind of business. So we talked about gross margin as one example of a ratio, and this gentleman just mentioned another, which is sort of days outstanding, so how long customers are taking to pay you. And if that, again, is going up or down, that may be a cause for worry. If that's going up, your customers are now taking longer to pay you, that's going to be a concern because it's going to factor into your financial modeling. Other businesses may have ratios or key statistics around customer revenue. So anyone who's ever worked in mobile would know a statistic called ARPU, which is ARPU, average revenue per user, which is like sort of the key statistic in mobile. So there's a lot of business industry-specific ratios, and I think the gentleman is absolutely right that they can give you a very quick assessment of the health of a business, especially as you see them changing over time. I don't know if there are other sort of key ones that you had in mind, sir, that you... Depends on the business. Depends on the business. I agree with you. Unless there are other questions, we'll stop here.
Well, thanks very much, Andrew. I'm sure you'll stay for a few minutes after if there are any questions.